So let's bring in here Stephen Miller, investment strategy consultant with GSFM Funds Management. Stephen, thanks for your time today.
Yep.
The really interesting thing about the US Federal Reserve, at one stage, markets sort of thought that maybe Jerome Powell was going to soften off. But then they realised when he came back hard and said, we aren't budging on this, we're going to beat inflation. As we just heard there, that's really spooked the markets and saw them in a further downturn.
No, it certainly has. I mean, I think the markets were primed for Chairman Powell to sort of signal a pivot. By pivot, I mean lower the policy rate increment, not at this meeting, go for 75 this meeting and down to 50. Now, they got that. What they also got, though, was that there would be ongoing increases, to use the chairman's language. And I think he also said they've got some ways to go to knock down inflation. So, yes, they got their pivot. And he also said, and I think this is the most important thing, is that they think the ultimate level of the policy rate will be higher than they thought at the last meeting. So, yes, we're going to get a pivot in December, possibly, but what we're going to get is more increases. So, more increases of a slightly less magnitude, leading to a higher terminal rate than what the Fed had previously anticipated, and that's what spooked markets.
So no surprise that the Aussie dollar fell, and it should be falling because with a rate here, a cash rate of 2.85% versus 4% now and going higher, it seems as though the interest rates in the United States are going to be significantly higher than what they will be here in Australia.
Yeah, I was a little surprised that the RBA only went for a 25 basis point increment. That September quarter inflation number here was an outsized increase relative to what the RBA was expecting and relative to, its longer-term forecasts. They had a lot of tough talk in the RBA statement about, the need to fight inflation, but only went 25 basis points, much less than some of their, or a number of their developed country peers. So they've talked the talk on inflation, whereas the Federal Reserve has walked the walk on inflation. So it might come back to sort of haunt the RBA that they weren't a little firmer now, because what it might mean when we come into next year is that they may have to play catch-up. Whereas the Federal Reserve appears to have learned, late in the piece, the lessons from the 70s, that if you don't stamp on inflation now, the potential macroeconomic dislocation in terms of growth and employment down the track may be much, much greater. Okay, that's why I think Chairman Powell wants to get on top of things now.
So let's go back to Jerome Powell and hear what he had to say about the future of interest rates.
If we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially.
And this is a big issue, Stephen, because people would say, well, we don't want a recession, we don't want a downturn, and that's reasonable. But what he's saying is you also don't want long-term inflation much, much higher. What are the consequences of that?
I think Chairman Powell doesn't want to be remembered like Arthur Burns. He wants to be remembered like Paul Volcker. The Fed, in the wake of the first oil shock in the 70s, it started to tighten, then it sort of eased off. It allowed inflation to become entrenched. Then we got the second oil shock in the wake of the Iranian Revolution. Inflation went into double digits. Paul Volcker came along and had to stamp on things very firmly, raising the policy rate then to something like 20%.
So hang on, but isn't that history? Isn't the world different now? It is history.
It is different, but it's not that different.
Yeah.
You allow inflation expectations to become entrenched into the system, that can lead to a sort of a wage price spiral. And you've got to really clamp down on things to get the inflation back under control.
So why doesn't the Reserve Bank go harder?
I think the Reserve Bank should be going harder. The Reserve Bank has made the judgment that it thinks it's got this inflation beast tamed. I harbour some reservations on that front. The Reserve Bank has consistently been surprised by the momentum and magnitude of inflation, and they're not alone in that in terms of world central banks. But the Reserve Bank, say, compared to the Fed, compared to the Reserve Bank of New Zealand, compared to the Bank of Canada, has thought that it doesn't need to be as aggressive as those three banks.
Okay, isn't it trying to really massage Australia into the soft landing? Wouldn't that be the preferred option?
Of course, if that were possible.
Yes.
We'd much prefer to avoid a recession, but that might not be the choice. The choice might be between a shallow recession or a growth slowdown or whatever you want to call it, or a growth recession, or a deep stagflationary type recession.
Okay, so stagflation, of course, is where you've got inflation, but you've got really low growth.
That's right.
Or no growth. And so that is something that hasn't been seen since the 70s.
That's right.
And that would be the worst of all outcomes.
That's the worst of all outcomes, and those banks that have lagged, say like the Bank of England or arguably the ECB, and I know there's things happening there that make it particularly hard for them, but they're the banks, they're the jurisdictions where stagflation, if it hasn't already taken hold, it's certainly looking as though they're going down that path.
One last quick one. It's all about employment. At the moment, there's full employment. There's employment shortages. But that can turn on a dime if businesses stop making money. That's your real problem if the unemployment rate starts to rise.
I think it is the real problem that, by not stamping on inflation quick enough, that we get both declines in activity and prices stuck at a level because inflation expectations have become entrenched. You get this sort of wage price vicious circle, and that's the worst of all possible outcomes.
Steve Miller with GSM Funds Management. Great to have you on the program. Many thanks for your time today.
Thank you, Ross.
We'll do it again shortly.
Thank you.